So as you know, we have calculated the income tax expense for the current year. We took the current year estimate or provision. We added the under provision. Under provision increases the current year uh, tax expense. Over provision, we need to reduce and adjust the current year estimate or current year tax expenses with that. Over provision, we need to add because this year we need to provide extra. So this year we need to pay the taxes. It will increase your tax expense. And as you know that last adjustment we discussed, in addition to the temporary differences relating to the information in note 2, that is this note 2 was with respect to revaluation surplus. So you remember the asset, we took the working notes, right? We knew that the revaluation gain was 7,800. So 7,800 was the revaluation gain, which was, with respect to work adjustment number 2. This revaluation gain also will create a taxable temporary difference. Why this will create a taxable temporary, a temporary taxable difference? Sorry, it will create a temporary difference which would be taxable, or DTL. I would rather use this word because the carrying amount due to revaluation gain will be more than the tax base. Whenever the carrying amount is more than the tax base, that means the asset which you are showing in your financial statements is more than the assets which you are showing in the tax returns. That means here the depreciation has been charged less, here the depreciation is more. Less depreciation, accounting income increases, and also provision increases. You pay higher provision, but you pay less taxes. So it creates a DTL. So this 7,800 which is creating a taxable temporary difference, because in tax returns you showed your asset less by 7,800, and in your financial reports you showed your asset more by 7,800. So this created a temporary difference between them, which is taxable. So temporary difference is 7,800 into tax rate, which gives us the amount, the deferred tax liability, which increases the future tax expense. Okay. Now this we will adjust with the revaluation gain only. Okay. We will, because this is the deferred tax liability created because of this revaluation gain. So this has to go in the OCI section. In OCI section, however, we're going to show 7,800. From there, we're going to subtract this. So your asset value is going to be how much? Calculate and tell. That means revaluation surplus is going to be how much after reduction of taxes? 6,240. This is your revaluation surplus. This revaluation surplus is a part of equity section. Okay. So this adjustment also, the note 2 is done. 6,240. Now what we are discussing is apart from that, note 2, the carrying amounts of Triage companies' net assets are 12 million more than their tax base. So carrying amount more than tax base by 12 million creates a taxable temporary difference. So 12 million into 20%, 2,400. This is your deferred tax liability. The balance what you were showing there was this much. Now it is this much. Your deferred tax liability has got reduced. Liability reduced, will reduce your taxable expense, your tax expenses. Sorry, your tax expense 2,700 plus 700 under provision minus 800. So 2600 is your income tax expense to be shown in the statement. Let's calculate and find out the profit, adjusted profit figure, and make the balance sheet. So 30,000 minus 250, 14,327. So profit for the year. Okay, finish this. We'll make the balance sheet now. SOFP of Triage company as at 31st March. Now we'll take the assets. You know, non-current assets, property, plant and equipment. What was the property, plant and equipment? So we have to take the, asset 66,300 was the asset after 6 months of revaluation, minus the depreciation after revaluation. Just see how much is that. 64,600. See, this is the property, plant and this is the property after revaluation. The value of property is this. 6 months depreciation we have to do, because we have to show the assets carrying amount at the end of the year, that is on 31st March 2006. 64,600. And then we had one more asset, right? It was the, we have to do at reducing balance. So 44,000 was the asset value. From that 6,600 we have to remove the depreciation. Current year's depreciation. $37,400. $1,02,000. Current assets, receivables, from trial balance is 28,000, and till date the whole amount lost is total of 7 lakh fraud. That means you have to take the net receivables. Okay, 450 adjusted this year, 250 has to be adjusted. Fraud amount. Any other current assets as per trial balance? 9,300. Do the totaling. 1,38,600. We'll go for the equity and liabilities element. Have a look through this. Any doubts, please ask. Equity, how much? 50,000. $1 is the share value. We'll do the return earnings part. So we'll take the opening balance of retained earnings, 3,500. Current year profits will add. Current year profits is 14,327. And that fraud adjustment, which has to be done. Actually, what did they say about this? 4,500 of this related to the year ended 31st March 2005. Rest to the current year. So we have taken whole 700,000 in the balance sheet. Current years we are showing 250. The old one is 450. So when we are reducing our whole receivables by this, current years and prior adjustment also we have to do. Okay. Because we are reducing our receivables by entire 7 lakh, the whole amount lost, current year and prior period adjustments. Because mid of the year it was discovered, right? And 7 lakh which had been included in the receivables in the above trial balance had been stolen by an employee. It was included. Actually, this has the fraud has happened of this much total amount. So we remove this. This much is related to the year ended 31st March. So the opening trial balance, the opening balance of retained earnings in the trial balance, retained earnings as at April 1st, 2005, opening balance. Now with this we are adjusting the prior period adjustment. That means we are the complete 700,000 has been removed from the receivables, which was there in the receivables, but this fraud has happened for this much amount. So this amount, there is a loss of this much amount from the receivables. We remove the entire amount. When the entire amount has been received in the asset side, in the equity and liability side, we have removed the current year fraud, and also we have to do the prior period adjustment. The current year fraud has already been taken in the P&L in the P&L account. That means the SOPL what we did there, we have already taken the current year fraud balance. So the prior period adjustment we will do in the retained earnings account. So again, this much amount fraud has happened. The whole amount has been removed from the receivables because it's a loss. 250, we have shown the current year expense fraud due to fraud. This much loss has happened. We have shown in the current year profit or loss statement. And 450 is the prior period adjustment we need to do. This much, the total we have lost, this much we showed, and this much we are yet to adjust. So we are adjusting. This much already adjusted in the current year profit or loss statement. This much prior period adjustment is yet to be done. So this yet to be adjusted amount we are adjusting right now. So fraud prior period so the retained earnings balance is how much? Closing balance. Next part. Now, retained earnings is done. Yeah. So you remember we started our calculation with equity element. You remember I have explained you in the working note number 1. We calculated the equity element. That equity element was 2208 to be taken in the equity section. So we're going to take this. Other component of equity. This is done. Revaluation surplus after adjusting the deferred tax. So what is the total of equity? 50,000 plus 17,000, 377, 2208, 6240, 75,825. Now we are going to do the liabilities part. Non-current liability, deferred tax. See, the deferred tax liability is 2,400. The 20% of 12 million plus 1560. See, 12 million into 20% was 2,400. 7,800 into 20% is 1,560. The total deferred tax liability is how much? The taxable, the taxable temporary difference. Temporary taxable difference is totally 3,960. Once have a look through this. So taxable temporary difference, DTL, we have written the amount. So the taxable temporary differences were 12 million and 7,800. This the asset value increased by this. So carrying amount became more than the tax base and created, and this, carrying amount being more than the tax base, the real reason is taxable temporary difference of 12 million. And carrying amount in second case also became more than tax base due to the revaluation gain, which is 7800. This is again the taxable temporary difference. Taxable temporary difference. This is also the taxable temporary difference. This into tax rate has given me the DTL amount. This into tax rate has given me the DTL amount. The DTL amounts are the first case here 2400, and here the second case is 1560. Both the deferred tax liabilities are 3960. So what is the root cause for deferred tax liability? Taxable temporary differences. 12 million, 7800, whatever. These two amounts are taxable temporary differences. This created what? Or this gave, this was the root cause, or this created what? The deferred tax liability. Both we have taken. Now, finally, convertible loan notes. So, convertible loan notes, we have already done the calculation for convertible loan notes, right? What was the calculation we did? So, we will again take that figure. 37,792. 37,792 was the liability element. Okay, with this, what was the interest expense? 3023. What is the interest payment? 32400. Okay, see that what is the answer you're getting? Just calculate. How much is the amount? Just do the calculation. 7,700 plus 3023 minus 2400. 38,415. So this is the interest expense charge. This is the interest payment, and the difference actually accrued interest, outstanding interest of how much is, the balance 3023 minus 2400. 623 is the accrued interest. So actually what I mean to say, 3023 is the interest expense. 2400 is the interest paid. So how much is still to be paid? 623. So this is your accrued interest. Okay. So this we added. Okay. This accrued interest is also a liability. So already convertible loan notes, which is a liability for the company, and accrued interest, outstanding interest liability. The whole amount comes to 38,415. Clear? Again, a very, very important element. The interest expense for the year is 3023. The interest which is paid is 2400. 623 is outstanding interest to be paid, or accrued interest, which is a liability. So both the liabilities I am clubbing together and taking it 38,415. So we have to So you can make a note of this. And then current liabilities. This year, you have to pay the taxes. How much was the tax expense we calculated? So this year's estimate is 2,700, right? That much tax we need to pay. Yeah. So current tax payable 2,700. This is the current tax estimate what we made. And what more amounts are left over in the current liability section? 17,700 is the current liabilities. So we will add all of them and try to see whether they are matching. So 75,825 plus 3,960 plus 38,415 plus 2,700 plus 17,700. 1,38,600. So this is what is the total of equity and liabilities. Just check it. Any doubts, please tell me. Let me know. I'm just scrolling up. Just say so whatever the estimate company makes for the current year tax payments, that is only the liability for the company for the current year. So that is what we have taken. This much estimate they made and this much they owe to the tax authorities. Okay. This much estimate they made, but they did not make the payment of this much. So this is the current liability. This is taken as current liability in the balance sheet. Generally, what is the entry for your, like, whatever the estimate you make for the current year, income tax expense to tax payable. So the estimate which we made was 2,700, right? Which was already given. A provision of this much is required for current income tax on the profit of the year to 31st March 2006. So the entry also passed, income tax expense to tax payable. So current year estimate is a tax expense shown in the statement of profit or loss, and tax payable is the current liability shown in the statement of financial position. That's it. So we are done with this question. Everything is clear and done. So today we have finished Triage companies, Sopl and Sofp. It was a very, very big question. Tomorrow we will cover Haverford. The state will make the statement for income statement for Haverford. Okay. So be ready for tomorrow in the evening. Thank you so much. I'm just canceling now. Thank you.